Hey, good morning once again, options traders. Well, I've got another cool strategy for you. This one is the Seagull strategy, and there's a good chance you have not heard of it referred to by this name. I've brought up some other strategies in the past with this same idea. And part of the reason I wanted to show this is that whenever you're introduced to a strategy that you might not know by name, always remember that they are nothing but combinations of calls and puts, long and short. Those are the only choices that you get to create an options strategy. Not counting long or short shares of stock that could certainly be thrown into the mix, but if we're just talking about the options. And so the main thing is, if you're not familiar with the strategy, still take a look at it. Break it down synthetically, and there will usually be easier ways to understand what the strategy is. And so it is with the Seagull. So let's go take a closer look. What is the Seagull strategy? As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So let's start with the bullish Seagull. Remember, for all strategies, there's a bullish version and a bearish version. So for the bull Seagull, you will start by selling an at-the-money put. And then you will buy an out-of-the-money put and an out-of-the-money call. And part of the thing that you're trying to do is to establish this for a net zero, meaning that there's no net cost. Now, does it have to be? No, it doesn't have to be. And in the real world, it's going to be unlikely that you're going to get exactly a net zero. But that's the idea behind it. So for example, let's say that you sell a $100 put and then you buy a $90 put. Notice that that strike is below. And then you buy a 110 call. So that's 10 points above. So what you're really doing is that you are buying an extra wing on top of a vertical spread. So that's one way to view it. In other words, if you buy the 90 put and sell the 100 put, that is a short put spread. It's a bullish spread. But then you're also buying this 110 call on top of it. That's one way to see it. What else could we do? Well, let's take a look at the 90 put and the 110 call. Those two right there are a strangle. So remember, there's different ways we can pair these options up and get different views. So we could also say that you're selling usually an at-the-money put and then buying a strangle. Just buying a lower strike put and a higher strike call, kind of wrapping this strangle around that short put. So here's what it does. Here is the short put by itself. There's our bend at 100. So again, we're going to, generally speaking, sell the at the money. Now, if we wrap a strangle around it, let's say here is the long 90 put. There's the bend at 90. We get another bend at 110. So in black is the 90, 110 strangle. And if we combine these two, this is the resulting risk graph. And that is your Seagull strategy. So right there in the center is the naked put. And then when we combine it with the strangle, we could also pair this 90 put up with the short 100 and make that a vertical spread right there. And then we can also see that we just have this extra 110 call up here on top. So again, probably the easiest way to see it is that it's just a vertical spread, but instead of having limited gains, we're going to make them unlimited. We're just going to buy this call to put at the top of this vertical spread. Now, the strategy gets its name because if you kind of use your imagination, which is something you have to do with a lot of the names in these strategies, it kind of looks like the seabird in flight, kind of off in the distance there. That's what it's supposed to look like. Now, of course, prior to expiration, we don't look like this. This is our expiration graph. We're going to look something like this. That red line, much straighter, but still that same general shape. Now, sometimes traders see this risk graph in black and they think that it looks a lot like the super bull or super bear strategies that we've talked about before. Kind of a similar look. So here is a super bear strategy. Remember, it's going to be the purchase of a spread, and then we finance it, in this case, with the sale of a naked call. So they kind of had the same general shape, but if you look at it, if we invert this blue one, in other words, if we take the short side, we're going to do this. And now you can see that the short super bear strategy is the same as a bullish seagull. So as I mentioned before, all of your strategies have a bullish and bearish version, so there is a bearish seagull. It's just the opposite. You're going to sell an at-the-money call, buy an out-of-the-money put, and buy an out-of-the-money call. And generally these out-of-the-money calls and puts will be surrounding that at-the-money call. That's your strangle. And again, you're trying to do this for a net zero. So for example, let's say that you sell a $100 call, you buy a $90 put, and you buy a 110 call. What did we do here? Well, same idea in reverse. There is the sale of the $100 call. There's our bend at 100. We know that we have unlimited upside risk with a naked call. If we buy the 90-110 strangle in black, that's what we get by itself. That's the strangle. And that's going to be done by buying the out-of-the-money put that we saw on the previous screen, buying the 90 put, and buying the 110 call, buying the out-of-the-money call. So again, notice that these in green, the out-of-the-money put and out-of-the-money call, are surrounding the at-the-money call. Same thing for the bullish version. We're going to sell that option there in the center, and then we're going to wrap this strangle around it. So if we did both of these strategies in our account, we sell this at-the-money call and buy this strangle, we get this. And this is now the bearish seagull. So let's break it down. There is the short call, or the naked call. But remember, we've also purchased the strangle. We bought the 110 call up here. So we're not going to continue into unlimited losses to the upside. We're going to flatten out. So if we choose, we could view this in a different way. We could say, all right, I've sold the 100 call, but I've also bought the 110 call, which is just a bear spread. It's a credit spread. And then I'm going to buy this put out here to have unlimited downside gains. And so that would be the bearish seagull. If we look at it prior to expiration, we're going to look like this in red. Always remember that the red line moves towards the black as we move towards expiration, and then right on the expiration bell, we're on that black line. Now again, people look at this and they say, well, it looks an awful lot like the Super Bull. But remember, the Super Bull is a long spread up this way, bullish spread, and then the sale of a naked put down here. So if we invert it, if we flip it from top to bottom, we would do this. And now we can see that the short Super Bull is in fact the same as a bearish seagull. So there you have it. There's your bull and bear seagulls. They're really not that bad once you learn to break them down. So I hope that helps. Even if it's not a strategy you ever plan to use, at least it can help you to understand how to break a strategy down by looking at the component parts. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.